Hello, welcome to the Global View on this Wednesday. I'm Andrew Gagan. Great you can join us here at Ausbiz. Let's get across what happened overnight. Global equity markets extending gains with new record highs for the German and Spanish bourses off the back of slowing inflation there in the Eurozone. Stocks on Wall Street continuing their ascent with the Dow and S&P 500 also at new record highs, while chip stocks rallied on renewed AI optimism. Memory and storage tech stocks rallied after NVIDIA Chief Executive Jensen Huang detailed upcoming AI processors that include a new layer of storage technology. SanDisk, Western Digital, Seagate and Micron all hitting record highs, seeing the chip index rising some 8% in the first three trading sessions of the year. And comments from Jensen Huang about the efficiency of the company's new chips raised concerns about demand for data center cooling systems, sending shares of Johnson Controls and Trane Technologies lower. Tesla slipped into reverse again after the NVIDIA chief executive announced the Alpha-Mayo family of open source AI models and tools designed to accelerate autonomous vehicle development, while shares of ride-hailing firms Uber, Lyft and Grab rose off the back of that. Moderna jumped after Bank of America Global Research raised its price target on the drug maker. And AIG shares fell heavily after the insurance giant said Chief Executive Peter Zaffino would step down. Well, while geopolitical events headlined by the turmoil in Venezuela remain a distraction for markets, investors are awaiting the first batch of data for the new year, with key US jobs data due this week. Richmond Fed President Thomas Barkin has said both sides of our mandate bear watching. Unemployment remains low on a historic basis, but has ticked up. Inflation has come down, but remains above target. While Fed Governor Stephen Miron has reiterated his call for aggressive rate cuts, saying policy is clearly restrictive and holding the economy back, well over 100 basis points of cuts are going to be justified this year. Meanwhile, in the Eurozone, inflation slowed more than expected in some of its biggest economies last month, while economic growth held up. Inflation in Germany, the bloc's biggest economy, slowed to 2%. In France, it slowed to 0.7%, and in Spain to 3%. And according to the S&P Global Purchasing Managers Index survey, the Eurozone economy expanded at a slower pace last month, but ended 2025 with its strongest quarterly growth in more than 2 years. US Treasury yields edged higher as traders waited on key jobs data. The yield on the 10-year was at 4.17, the 2-year at 3.47%, and the US dollar edged higher against most major currencies, with the euro weighed down by the softer inflation data there. The Aussie has climbed to 67.4 US cents. Oil prices have eased further, with the market weighing expectations of ample global supply this year against uncertainty around Venezuelan crude output after the country's President Nicolas Maduro was captured. Brent crude futures down more than 1.5% at just under $61 a barrel. Gold has extended its gains, buoyed by safe haven demand amid heightened geopolitical instability. Spot gold nearing a record, up at close to $4,490 an ounce. Copper has surged 5% to hit a new record, and iron ore is up to $106 a ton. Bitcoin is trading at around 93,000 US dollars. Well, let's get across what is moving markets globally. I caught up earlier with David Lane from Ordminet.
It's been an interesting period, I suppose, that we're seeing in the US. Still quite a bit of optimism about the AI trade. We saw that NVIDIA and many of the other AI-related companies did well last night. And there's also still expectations in the equity market, at least, about potential further interest rate cuts in the US from the Federal Reserve. The bond market, however, is telling a different story. The bond market isn't as confident that they'll get further interest rate cuts, but equity investors at the moment are anticipating that there will be further cuts this year. So relatively optimistic in the US, and some of the European markets did quite well. We also saw commodity prices quite strong again overnight. So gold and silver were very, very strong. So I think what's interesting in the Australian market is that positivity is working for some of the market, and we saw that yesterday, that the resource stocks were performing quite well, but investors are still concerned about overall valuations, and in particular valuations about the banks. So we actually saw a bit of a sell-off in the banks. So we often refer to the barbell of Australia, where you've got the weight of the the banks and the weight of the resources. At the moment, we're taking some plates off the banks and putting it onto the resources. So we've seen our index relatively flat because that barbell is unbalanced, and you can't lift it if it's unbalanced.
Well, how's that likely to play out over the course of the year, do you think, David? Given that certainly at the moment we're seeing the Aussie market underperform relative to global peers, and that was also the case particularly against Wall Street last year.
Absolutely, yeah, and I think that we are we do have a very different market to the US. Most of that gain in the US was AI related and tech related. We don't have anywhere near as much of our companies involved in that side of the market, and indeed many of those tech stocks had their own issues, governance issues and the like. So we did see a lot of volatility in our own tech stocks. But I think those concerns about valuations are relevant both here and in the US. At the moment, it seems that the US investors aren't as concerned about those valuations, and there is that expectation that there will be continued spending as far as AI is concerned, and as I mentioned, the potential of interest rate cuts in the US. So a little bit different here. I think in Australia, as you said, we did underperform. When you include our dividends, our performance was a little bit better, and I've actually seen a number of analysts who are talking about the fact that in 2026 that dividends will be very important as far as long-term returns are concerned, because the expectations for growth aren't as strong. And again, we've got different expectations as far as interest rates are concerned. So today we'll get the CPI figure out, which I think investors will be looking very closely at. And at this point in time, there's a range of schools of thought as in terms of whether or not we'll get any interest rate cuts this year. And indeed, some people are even suggesting we may get potentially interest rate rises if inflation does stay as sticky as it has been over 2025.
Interesting, given that divergence we're seeing between the US and Australia, obviously off the back of inflation and rate expectations. You mentioned what's going on here in Australia. It is a different story in the US. Some key jobs data coming up this week. Also,
Absolutely.
We've got increasing commentary too from Fed members. For instance, overnight, Thomas Barkin saying we need to watch both jobs and inflation. Inflation, he's saying, remains above target. But then we've got the very dovish Stephen Myron reiterating his call for aggressive rate cuts, pointing to 100 basis points of cuts this year.
Yeah, unfortunately, I think that the Federal Reserve has become very much a political football at the moment, and we know that President Trump wants to have a new chairman in place, and there's a lot of machinations happening over there for people posturing to get that position, and it certainly looks as if the Federal Reserve is becoming a lot more political than it should be. But as you said, that jobs number will be very, very important. We had that government shutdown late last year, so there was a bit of a dearth of information coming out of the US. So this will be one of the first major, true indications of that jobs market since we had that shutdown. So I think that will be very important. And as you said, the US economy, in spite of what Donald Trump might tell us, is actually relatively slow and looks as if it's slowing. So there are concerns about the growth out of the general companies in the US. I mentioned the positivity from the AI sector, but the rest of the economy is still struggling a little bit. So, I think if the US does get 100 points of rate cuts, that indicates that their economy is slowing and that they do actually need to do a bit of stimulus. So, 100 points of rate cuts may not be a positive thing.
In fact, just in the latest PMIs, we can see the continued effect of tariffs on the US economy as well.
Absolutely, yeah, certainly. Those tariffs are starting to bite, and even recently we've seen a little bit of indication that some of those will be wound back or diluted somewhat, because it is having a bit of an impact on the economy. And Yeah, the growth expectations for the US economy aren't as strong as they have been in recent years. So certainly they've got a bit to wade through. So we may not see that positivity that we've seen in the last couple of days continue for all of 2026. And I think, we may well see a bit of a volatile period over the coming months.
David, meanwhile, M&A continuing out of pace. Of course, the headline most recently, BlueScope, SGH making its tilt with its American partner. The key there, they're wanting to break it up, sell the US assets to its American partner. How do you see this playing out?
Yeah, certainly. It was confirmed yesterday in the market, and the shares jumped very strongly, jumped about 21%. So interestingly, they're trading very close to that $30 offer price. At this point in time, the offer is still non-binding indicative, but the shares have rallied. The market, at least, is sort of anticipating that may well occur. Interesting that Steel Dynamics in the US didn't have much of a movement as far as their share price is concerned. But investors in BlueScope obviously pleased about that. I think that it may well occur, but very often we don't see the first offer being successful. So that will be an interesting one for BlueScope investors to look at. But across 2026, there are a lot of expectations of quite a bit of M&A activity. Our analysts actually looked at it late last year and did a bit of a quant screen on a number of the small to mid-cap stocks that we think have the potential of being taken out because, I mentioned earlier that the high valuations of AI stocks or banks, that hasn't necessarily been the case as far as small cap or mid-cap stocks are concerned. So there's a number of companies that are trading below fair value that could well get taken out this year.
David Lane from Ords. All right, let's take a look at the local market then, just ahead of the start. Expecting a strong start. SPI futures up close to 0.6%. Not a lot of corporate news around today, but the focus very much will be on that inflation read for November. So we'll get that key CPI data about 11:30 Eastern, and we'll get plenty of analysis off the back of that as well. Stay with us for the open.